Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Ryan Thomas. He is a portfolio manager at Hotchkis Wiley, and we are talking about their newest ETF, ticker HWSM, which is the Hotchkis Wiley SMID cap Diversified Value ETF. We talk about how the process works. It is a mix of quantitative as well as human analysis review. I think it's very thoughtful portfolio construction. So without further ado, please welcome Mr. Ryan Thomas. Hey, Ryan, welcome to the show.
Thanks for having me. Happy to be here.
So before we get started, why don't you kind of take a little bit of time to talk a little bit about your background and how you ended up at Hotchkis Wiley?
Sure. Well, I started my career in investment consulting, and I worked at a couple different places, the last of which was called Slocum and Associates, which has since been acquired and I think is now part of under the Mercer Consulting umbrella. But I had a great experience there. That firm had a very fun culture, great leadership, talented people. So I learned a lot. One of my probably the primary responsibility that I had there was to conduct due diligence on equity asset managers. And as it happened, Hotchkis Wiley was one of those firms that I was researching. And, I was impressed by the firm, its people, its culture, its process, its leadership. And so I was ultimately advocating that our clients would use them. And then you fast forward a bit, and at some point, Hotchkis Wiley was actually looking to add someone to their team, included me as a potential candidate, and I ended up joining in 2008. I think since then, my roles evolved a bit, most notably becoming a co-portfolio manager on our small cap diversified value strategy. A little more than a decade ago, I joined Judd Peters as a co-manager for that. He had been managing it as the lone PM for 10 years, and it's been the two of us for the last 10 years. And then more recently, we started two other strategies that leverage that same process, just applied to a different opportunity set. One is an international small cap strategy, and the other is the SMID diversified strategy, for which we just launched this ETF.
Yeah, no, we're definitely going to talk about the ETF in greater detail on the show. But before we kind of get into business, any hobbies? What do you like to do when you're not working?
Yeah, well, I have a couple daughters. The older one is well into her teens and pretty self-sufficient at this point. The younger one is 10, and she's a competitive dancer, which makes me a competitive dance dad. So depending on the time of year, I'm likely watching competitions or recitals. Not exactly how I probably envisioned it as a younger man growing up, but it's fun to watch, and I wouldn't trade it for the world. And if I have kind of true Ryan time, I guess I'm probably at the golf course. I just like the outdoors, spending time with friends. And that's probably the way that anybody that loves golf but isn't very good at it would describe it.
Yeah, well, and I'm sure dance competition weekends eat into your ability to sneak out on a Sunday or Saturday morning.
Excellent point.
Yeah, well, any young dad can relate to that who likes golf. So, look, why don't we talk a little bit about the firm in general? I mean, what all do you guys do to help clients? I know you have the products, which we're going to definitely move into, but what are all the things you're really doing to help support your client base and the things that you're delivering to them?
Sure. So, Hotchkis Wiley, it's a 45-year-old firm founded in 1980 by John Hotchkis and George Wiley. They both retired in the mid 1990s and have unfortunately passed away, since then. And we manage today somewhere between 30 and 35 billion dollars across a suite of value equity strategies and also a high yield credit business. Um, so the firm's majority employee owned, and I would classify it very much as a research firm. If you were to just look at the headcount alone, if you add up the research team, the research associates, the trading team, so basically everybody that's solely dedicated to the research effort, that's more than half the headcount of the firm. And I think that's a pretty uncommon ratio in our industry today. I've been here 17 years, and I'm pretty confident I've never been the smartest person in the room in those 17 years. And I've been in a lot of meetings, probably one-on-one meeting with everybody at the firm by now. So I'm constantly impressed by really the intellectual horsepower of the team, which can be intimidating in some circumstances, but here it's not, and I think it's because of the culture, which I view as very phenomenal. It's challenging yet very collegial, very collaborative, and so I definitely think highly of where I work, and I'm proud to be part of it.
Oh, that's great. So you guys recently launched the SMID Cap Diversified Value ETF, ticker HWSM. Can you talk about having such a long history at the firm? What kind of inspired you guys to enter the ETF game? And if you wouldn't mind, maybe just talk about what the fund's trying to accomplish at a high level.
Sure. So yeah, like you mentioned, the SMID ETF, we just launched it at the end of March or early April of this year. The SMID strategy, so not the ETF vehicle, but the strategy itself via separate account, dates back 2.5 years. But the investment process that we use for that strategy is effectively identical to our small cap diversified value strategy, which is a $3 billion strategy that dates back 20 years. So the strategy is only a few years old. The ETF is only a couple months old, but the process kind of dates back, 20 years. And the firm offers, value equity strategies really across the cap spectrum and also, globally. And we offer different vehicles to access those strategies like SMAs, collective funds, mutual funds. And we hadn't until recently had an ETF, but I think we're just sort of learning that, they're becoming increasingly popular with investors. And so we thought it would be, a prudent time to get in that game, so to speak. And so we started with this strategy because I guess you have to start somewhere. And also, it didn't appear that there were a ton of small and mid cap ETFs out there. So we thought it would be a good place to start.
So why don't you walk us through kind of the core investment process behind HWSM and kind of what I've read, and again, you're the expert here. It looks like there is some quantitative factor to this as well as some analysts working on it, and those two things kind of work together. So if you could kind of just walk us through the core investment process here behind this particular fund.
Sure. So basically, it's a three-step process is the way I think about it. The first step, like you alluded to, the quantitative element where we run these proprietary models. The second step is we have an analyst review of those models. And then the third step is portfolio construction. You could sort of consider a fourth step being ongoing monitoring of it. But, that three-step process might not sound like a terribly unique strategy, but I actually believe it's a little more unique than it might sound on the surface. And there's a few reasons for that. First, I think these models that we use are different than what most quantitative screening tools that I've seen in the past. Typically, what those do is they look at various characteristics like valuation characteristics, price to earnings, price to book, maybe some other growth metrics, and then sort of come up with a weighted score or ranking. Ours do not do this. Our models are basically designed to try and replicate what a Hotchkis and Wiley analyst would do if they were analyzing this company by hand, given our investment philosophy. And that philosophy is basically that we believe the best way to value a company is based on its normal earnings power, or what a company should earn in sort of a mid-cycle equilibrium environment, not necessarily based on the current environment, although that's what market prices typically reflect. And so, put another way, margins and returns on capital tend to revert towards sort of normal or average levels over time. And so, our models try and estimate these long-term normal margins and returns on capital, which ultimately leads to an estimate of normal earnings per share. And that can be very different than current earnings, which again are typically what market prices reflect. They also make a variety of pretty straightforward accounting adjustments just to better capture the true cash economics of a business. But then we take the output of those models, and if it looks attractive, we'll distribute those to our analyst team to do a review. Our models are not perfect, and that's something that we fully acknowledge and something that is really, I think, remedied by the second step of our process, which is the analyst review stage, which is by far, in my view, our key competitive advantage. We have a 24-person investment team. It's a stable team. The average industry experience of that group is 25 years, and the average tenure with the firm is nearly 20 years. So that's an important asset for a firm like ours. It's the primary asset, that knowledge base that team has accumulated in their experience, and in their experiences working together. And this strategy is really designed to tap into that asset or tap into that body of knowledge. So the analysts will review the output of the models. They'll make adjustments or override any element of the model based on their subjective fundamental view of the industry and the business. And then we take those adjustments and save them in our database so that the next time we run our models, that adjustment is now reflected in the model's output. So that helps again with the efficiency of the process. And then from there, we go to the third step, which would be portfolio construction.
No, it's interesting. So how do you view kind of balancing that systematic model output with the human judgment, right? Like how much credence, I guess, when you go to rerun the model, does that most recent kind of, I'm going to use the term, well, let me use a different term, kind of human judgment. How much weight does that really hold in your next run of the model?
Right, it's a good question. So I guess the way I think about it is it's really the human adjustments that we're after, and I think that's what we would place greater value on. The models, I think, in my view, are a way to sort of house all those adjustments in an efficient way. And when you run a diversified portfolio, having efficiency embedded in your process is paramount. And so that's kind of how I think of it. Like the models are almost a research prioritization tool for our analyst team.
That makes a lot of sense to me as well. So one of the things I read too is you guys emphasize investing in out of favor and under followed stocks. So like, why is that a segment that's really compelling for you and your team?
Yeah, I think this process lends itself well to, I'd say, the less efficient segments of equity markets, and those tend to be on the smaller and mid side, side of things. You just have a lot of stocks there that are overlooked because there's less Wall Street coverage. There's also less buy side coverage. There's also a lot of stocks in that group that you probably wouldn't want to own. Negative earners, subpar businesses, those with a lot of financial leverage, those that might have below average management teams that aren't shareholder friendly. And so active management is, of course, about what you own, but it's also, about what you don't own because we are compared to passive indexes. And I think these out of favor, under followed stocks just present themselves in greater magnitude in these small and mid segments of the equity markets.
So I was reading as well that HWSM uses a proprietary fundamental risk rating system. Like, what does that score actually measure, and how does it impact your portfolio construction?
Yeah, so this is something that we employ firm-wide across all strategies. In this strategy, this would occur during the analyst review stage. So I referenced earlier that the analysts give us these financial adjustments to the models. They also give us these fundamental risk ratings. And basically what these are, they're scores of 1 to 5, 1 being very positive, 5 being very negative, on 3 different sort of risk pillars. One would be the quality of the business. The second would be the strength of the balance sheet. And the third would be the quality of its corporate governance. So simply put, the better these scores are, the higher the valuation that we're willing to pay, and vice versa. So if these scores were not great, we would need a very attractive valuation, and if they were flat out bad, we probably wouldn't own it at any valuation.
So let's talk about like rebalance frequency or cadence. How often are you kind of rerunning the model? How often are analysts kind of re-looking at everything? And how often are you going in and making adjustments and or rebalancing the portfolio?
So we do that kind of whole process that I walk through. We refer to that as our major rebalance process, which is really going from the process to beginning to end. We do that twice a year, and it takes about 6 to 8 weeks, to go through that entire process. In between that, we have minor rebalances, which take place no less than monthly, and that really involves primarily trading back to target weights just to take advantage of volatility in the market, but we'll change target weights if there's been a major change in valuation or risk. And we've used this cadence really just because we found it to be sort of the right balance of, making sure the work is fresh, letting the process work, and then also minimizing trading costs.
So I want to talk a little bit more about kind of portfolio construction and portfolio structure. It looks like the ETF holds quite a number of between 150 to 200 stocks. They have what I look at as like a tiered weighting. Kind of what's the rationale behind the tiered weighting? Does that have to tie back into the fundamental risk rating system? So like, how are you weighting these names inside of the portfolio?
So the 150 to 200, and we've been closer to 150 than 200, represents somewhere in the neighborhood of 10% of the eligible universe in which we can invest. And that's similar to the small cap strategy that we've been running for 20 years. That's worked pretty well. So it just kind of feels like the appropriate balance of being diversified, but still not an enhanced index strategy. The active share for this strategy is somewhere in the mid to high 80s at the moment. And so that's kind of the justification behind it. The weighting, the tiered weighting structure, the way it works is, and this is approximate, but we have approximately 50 names at 1%, 50 names at 0.6%, and 50 names at 0.4%. That gets you to 100%. So and that's largely based on just the attractiveness of the risk return profile. So in other words, half the portfolio will be invested in our favorite 50 names, so to speak.
I got it. So the fund focuses on the SMID category. And it's funny, the last the episode prior to this is also it's a mid cap strategy, not a SMID strategy. But as we've known, kind of mid caps and small caps have been a little bit out of favor, which I think could make them a little bit more attractive in today's market environment, especially from a value perspective. What is the firm's overall kind of take on this area of the market, and why SMID caps or small and or mid, or both of them combined in this particular instance, are kind of attractive given how the market has kind of relied largely on large cap growth over the last, 36 months?
Yeah, I mean, it's almost more like the last decade.
More than that. Yeah.
It's a good point. I think the large cap growth index is up like 350% over the last decade cumulatively, which is, I don't know what that would equate to annualized, 15, 16, 17%, something like that, where I think the index that we're being compared to, the 2,500 value, is up, like 100%, which would be whatever, 7-8% over a 10-year period per year. So to say it's underperformed is kind of an understatement. I mean, large cap and growth has done it incredibly well. And to be fair, a lot of that outperformance, I think, is rational, considering that some of these Mag 7 type companies have grown at a pace that we've just never really seen before at that scale. So operationally, they've sort of outperformed expectations and have grown earnings at a pretty rapid rate. So that explains some of that outperformance, but there's also a lot of it that is simply a widening of the valuation gap that you kind of alluded to. Where if you look at sort of the area that we're investing in today. So again, if you just took the Russell 2500 value, the PE ratio on a forward PE ratio is right in line with its, say, 20-year median, or very close to it. If you look at the Russell 1000 growth, it's like 30 times forward earnings, while its 20-year median is 20 times. So well above its sort of long-term average and well above other parts of the U.S. equity market. And so if you believe that a valuation reversion is more likely than not, we would be in that camp. I think that would be good for small and mid caps, and also good for value relative to growth. But I also got to acknowledge this is probably a better case against large growth than it is for smaller and value companies.
So this is always $1 million question, right? You're working with an RIA who's already has a diversified portfolio. Where is HWSM where is its role in that portfolio? Is it kind of a core holding? Are you looking at kind of satellite exposure? Like, how would you kind of go into that conversation recommending how to use this particular product?
Yeah, I think a core long-term holding would make sense. I mean, if you have an individual or a plan that's looking to simplify their lineup, so maybe not have small and mid and get that together. Maybe we would pair well with a SMID growth manager. I think that would be a pretty logical balance. And I think so. Investing in this, even though the track record isn't very long, it does provide access, I think, to, again, the knowledge base of a very large and experienced team.
Well, I think too, you have, as you just said, I mean, you ran a very similar small cap diversified value strategy for 20 years. And so there's enough track record there for people to kind of leverage. But, as you just alluded to, this fund was launched fairly recently, and you guys are newer to the ETF space. So far, how is talking with investors going, and really how are you trying to position this in the overall market to try and start getting distribution? Because as we've seen, there are so many funds entering the marketplace. It's becoming very noisy and crowded. So would love to hear how you're trying to reach advisors or investors.
Yeah. So I think, to be honest, I think our marketing folks could answer this a little better than I could at this point. And the reality is, it's been so early. It's so early right now. It's really hard to say how things are going so far, because it's been literally months. And I believe our focus is generally on, say, large RIAs, bank trusts, broker dealers, and really any individual that's kind of the do-it-yourself investor. So I think time will tell what the interest level is going to be, but I think at this stage it's really just too early to give you clarity on that.
Well, Ryan, I mean, congratulations on the launch. I know it's it's definitely exciting, and it's a way for the firm to kind of continue its legacy, even though it's been kind of in the SMA business for so long. It's kind of a new chapter, so it's exciting for you guys. But I really appreciate your time here with me today. But before I let you go, where can people learn more about the firm, and where can they find information on your ETFs?
Yeah, the best place is our website, HWCM.com. It has a bunch of information on the ETF and our other strategies. We also have a LinkedIn page where we post content occasionally. So you just search for Hotchkis Wiley Capital Management on LinkedIn.
All right. Well, again, Ryan, thanks so much for being with me.
Yeah, I appreciate you having me. I enjoyed it.